Woohoo, and welcome back. Today on Carnivore Theater, Sharktopus and I will be discussing the difference between bull markets and bear markets. Woo, yay! And as you can see, Sharktopus has generously agreed to join us and has gotten into the spirit of it because he found this little hat in his attic. I don't know where Sharktopus has an attic, but friends believe friends. So whether he ran out to the costume store and got himself some bull horns or not, I don't know. I don't ask questions. But bull markets versus bear markets. So when we're talking about bull markets versus bear markets, there are two different definitions. The official definition that economists use is that a bull market is a period of generally rising prices. And this could be for the whole world, if you're looking at the whole world's economy, or you're looking for the whole world's trends, or one country's markets, or you're looking at one sector. You could be applying this to all sorts of different situations. But basically, it's rising prices. And the optimism, people get excited. Prices are going up. They're thinking, I'm going to make some money. And that fuels buying, which fuels higher prices. Because as more people want to buy something, demand is outpacing supply. And so that pushes prices up. Economists officially call a bull market when prices rise by 20% or more. So a bear market is basically the opposite of all that. It's a period of generally falling prices. Again, this could be of the whole world, of one country, of just one market, of one sector. It could be applied to a lot of situations. But in this case, people get scared when prices start to drop. That means if you have the stock, if you own the stock, it's suddenly worth less. And so people panic because they see their account balance go down. And this causes people to freak out and want to sell. And so when people are trying to sell, that means the supply is greater than the demand. So that makes prices go down. And again, this is officially called when prices fall by 20% or more. And there's another interesting little term, a correction. A market correction happens if prices start to fall between 10 and 20%. And that's called a market correction. So usually what happens is people get too excited and start, wanting to buy and buy and buy. Everyone gets really excited. And then suddenly everyone comes to their senses and goes, whoa, the prices are way too high. And so generally demand cools. And so there's a correction. And the term correction usually means that that particular stock or sector or market is just correcting itself and getting itself back into, better pricing, more rational pricing. And correction does not always lead to a bear market. So it's called a correction, meaning it's, in other words, if you find yourself you're driving way too fast, you hit the brakes a little bit and that slows you down, but you don't have to come to a dead stop. You just slow yourself down so that you get back to a speed that you're comfortable with. So this is all what happens for economists. Now, for the rest of everyone, bull and bear still mean the same things, but people will often refer to bull and bear much more loosely. So they don't necessarily follow this 20% rule or even the 10 to 20% rule. So in general, how do you remember? Okay, here's where Sharktopus has got us. See, Sharktopus has got the bull horns on. Woohoo! And so, generally speaking, if you're talking about a bull, you put your fingers up to be the horns, and that means up, prices are going up. Now, if you're talking about a bear, what you want to do is you want to make a bear claw, rah, right? Except you'd be doing it this way, but I'm not facing you, so it's harder to do. And basically the shape of the fingers are pointing down. So a bear market is going down, rah, and a bull market, I don't know what noise bulls make, but a bull market, bull horns go up. So bull is increasing, bear is decreasing. Now, mathematically, what's going on? And here I've drawn just a general little image. It doesn't always happen this way. However, generally speaking, bull markets are followed by, so increasing markets are followed by decreasing, which is followed by increasing. And this is just the nature of things. I don't know, I didn't look into it, but I don't think any market sector has ever just gone straight up or straight down, right? Everybody's always wiggling. So inside of the wiggle, and again, officially economists say you have to increase by 20% for it to be a bull market, but more loosely, if it's an increasing, so it's heading up, prices are heading up, it's a bull market. Bull market is increasing. And for those of you who are mathy, that means the slope or the derivative is greater than 0. Then at some point, the price will hit its maximum for whatever reason. And this isn't just the price of one stock. This could be the valuation of a sector or the whole market. You know, if you're looking at an index like the Dow Jones Industrial Index, something like that, will hit the market top. Now, this doesn't mean it's never going to go above this. It just says just in this moment, we're hitting that maximum point. So for those of you who have studied calculus, this is a local maximum, but not necessarily a global maximum. And then as the prices correct or even move into a bear market, we've got decreasing, so it's decreasing curve, and that means the slope and or the derivative is less than 0. So it's heading down. And then eventually we'll get to a market bottom. And again, this is not a forever bottom. This is just in the moment. This is the point where it comes down and then prices go back up. And generally speaking, this, if you look at any stock, you'll see lots of little wiggles like this. It won't always be bull and bear because again, it's not rising and falling by 20%. Most markets and stocks are not that volatile. They'll be going up a little and going down a little. But again, with the jargon, people talk about increasing being bull and decreasing being bear. Things will be bullish or bearish, and how you're feeling about a particular stock slash sector slash market will be bullish or bearish, whether you think it's going to be long-term going up or long-term going down. And then there is one unfortunate or hilarious, depending on your particular perspective. And some of you may want to turn off the audio because this is not a nice term, but this is a term that is used. So I want to go over it. If you have a stock that is headed downwards, the price is decreasing. And again, I cannot stress highly enough that you should turn off the audio if you have sensitive ears, because this is not a nice term. So turn it off, and then I will wave to you when you should turn it back on. Okay, everyone turned it off? Good. So if a stock is falling, let's say the company did something really bad. Something has happened. The product is defective, or the people in charge have all quit, or something bad has happened. And so the price of the stock is falling. It turns out that a lot of times, as things start to fall, although it is true that falling prices usually create that fear that fuels a sell-off, people panic and sell, there are a lot of folks who realize, wait a minute, this is a sale. This is a cheap price, with the hope that the price will go back up again eventually, because prices will get down low enough and then people will want to buy it again. And so as the price comes down, there will be something called a dead cat bounce. And you heard me correctly, dead cat bounce. And the horrible, horrible meaning of this is that even if you throw a dead animal off of a tall building, anything you throw off a tall building will bounce when it hits the ground. I know, it's terrible, but you will hear it. And so I wanted to tell you about it. And basically what happens is if the price gets low enough, there are folks who will snag it up at that low price. It's, if you can get these, whatever this stock is, for pennies on the dollar or fractions of pennies on the dollar, they'll buy it. They'll invest in it. It's not a big investment, with the hope that eventually the price will go up, even if the stock itself is dead. So even if the company is destined for ruin, there will be a moment of slight uptick before it falls down again. And this becomes a self-fulfilling prophecy. As the prices come down far enough, those people who are looking for a sale will buy it. And of course, what happens when when demand goes back up? Optimism fuels buying, which brings the price higher. So the people who believe that the price will go up cause the price to go up. And that's called a dead cat bounce. But the price won't go all the way up because the fundamentals aren't there. If the company is failing, something is just fatally bad with this company, eventually the price will come down again. But there are folks who take advantage of that, and that's called a dead cat bounce. Okay, everyone come back. Okay, unpleasantness done. So, what do you need to take away from this video? Woohoo! Just remember the difference between bull and bear. Bull generally means up because the horns point up, as Sharktopus is showing us. And bear means down. The bear claws, the fingers are pointed downward. A bear means decreasing. So that's it. Woohoo! I hope you've enjoyed this episode of Carnivore Theater. Yay! Woohoo! And math on.